As the senior financial manager for our bank, having an easily accessible and highly customized corporate performance summary consisting of my key performance indicators is an absolute necessity. As soon as I log into my Workday planning instance, I'm dropped directly into my corporate performance perspective. And from the onset, I'm able to quickly and easily identify the KPIs that are most important to the success and health of my business, such as my net interest income, my breakdown of revenue, as well as a quick spot check on my net income percentage. Now, having these high level KPIs allows me to keep my focus on maintaining the health of our business. However, should these KPIs not align with our internal expectations, such as seeing over $10 million on allowance for loans and lease losses, I've got quick access to my financial statements below should I need to review further or make any changes. It's also important to our institution that I'm not only able to access our core financial statements, but I'm also able to leverage Workday Planning to generate and calculate my month to date and quarter to date average financial statements as well. And these are crucial pieces of information around the health of our business and definitely something I will want to review personally before sending to our board. So now that I've reviewed and ensured the health of our business, we can start to dive into some of the details of our organization. And looking at our balance sheet on our company summary or our financial summary dashboard, we saw that the largest makeup of our assets are loans receivable, specifically real estate loans. Now, having direct line of sight into our real estate metrics is imperative for us to continue our growth trajectory. Based on incoming loans, we know that we're expecting to approve just under 75% of loans, which is in line with our corporate performance standards. But our pull through rate of accepted loans is just under 65%. We're going to want to work with our team internally to try and get this number up closer to our corporate standards between 70 and 75%. I'll also want to dig into my abandoned loan rate by branch specifically to see if I have any low performers. That way we can try to adjust some behavior as it relates to application follow-up and overall account management. So now that we've reviewed some of our key metrics, I'm going to want to highlight within my mortgage loan model our single family residential fixed loans. So this is going to be our largest asset currently. Now that I'm filtered on my single family residential fixed loans, we can actually utilize Workday Planning's active dashboard capabilities to view and if necessary, update and make real-time changes to our incoming mortgage loan expectations. So within this model, we can see that I can plan for estimated runoff on a particular branch, as well as a particular loan type, my breakdown of sold versus retained loans, and then I can get into my actual application specifics, such as incoming applications, how many approvals, how many estimated mortgages. So now that my real estate loan expectations have been adjusted, I'll start to move into my non-real estate loan expectations. So while I did utilize a top-down approach to planning my real estate loans, in this case, I'm actually utilizing a bottoms-up approach to plan for my non-real estate loans, including any type of consumer loans or any commercial non-real estate loans. So really quickly with Workday Planning's formatting capabilities, I'm actually able to distinguish my non-real estate loan expectations against my credit card portfolio. Now, while we're also able to distinguish our non-real estate loans from our credit card portfolio, I can actually see and interact with our data based on what we're seeing in the current market climate. So for example, in my credit line portfolio planning, as of right now, by each branch, we can take a look at our average credit balance based on our portfolio type of new customers, existing customers, any new students, or any new business customers. So in this upcoming year, we know that we want to make an effort to change or increase an uptick in our business client percentage. So I'm going to go ahead and make this change in real time, save my changes, and I'll move back to my dashboard. We can see all of our charts and graph styles update automatically based on those changes. In addition to being able to change any uptick in expected business, what I can also do is look at my credit card planning in real time. So taking a look at my total credit lines outstanding, our average expected credit card utilization, any effective interest rate, and branch one actually within our new credit card profile customers, We've typically seen an expected loss of 1.5% across the board. However, branch one is a little bit closer to 2.5%. So I can go ahead and make this change for my budgeting purposes as well. Again, I'm able to make real-time changes directly within my dashboard, and all of my charts and graphs and dials will update in real time. Lastly, to round out our asset planning, I always want to review our existing securities portfolio. Now, from this dashboard, I'm able to pull in high-level performance metrics ranging from our current interest income, our breakdown across each security, as well as what our all-in rate is by security. Now, based on the latest Treasury data, we're not expecting to make any changes to our index rates, but we will want to keep a close eye on those in case we need to adjust any of our spread rates in order to maintain our all-in rate consistency. While it's important to review our greatest assets through our loans and securities, it's critical to our business to see, monitor, and maintain our incoming cash flow that allows us to continue funding our outgoing loans. We can see and maintain both our deposit allocation spread as well as our average interest rate and view our expected volume. I can also drill into my average interest rate by particular deposit type, make sure that each one of our deposits are meeting expectations. Now, while deposits do make up the primary source of our funding, I'm also able to view our other positions from incoming escrow payments on both a monthly basis as well as on a loan by loan breakdown. But I can also see all of my current CD balance and rate information along with any corresponding interest payable amounts. Within my CD model specifically, what I'm able to do is leverage an average price by a typical CD type, as well as an average interest rate that we expect to pay out. Based on historical data, I'm able to populate my time span with expected CD purchases over the next 12 months. That allows me to build my accrued interest payable amounts, and it lets me build that by a particular CD as well. Lastly, I'm able to see any incoming service fee revenue from money orders. In this case, we know that we're going to be making an effort across the board to increase our money order service fee from the 1.5% to closer to 2.5%. So I'm going to want to make that change here. What I'll do is I will look at this by all levels. We'll change to 2.5%. What I'm going to do is I'll enter in the first month and then I will copy forward to the end, save my changes, and then we can move back to see the real-time changes in our expected service fee revenue. Lastly, the overall health of our business truly revolves around the people that allow us to operate and keep pace with an ever-changing marketplace. With Workday Planning, we're able to assess our application process and our staffing needs based on the current federal interest rate. And as changes come in, we're able to rapidly adapt to meet the business's needs. So if we were to expect a decrease in the federal interest rate from 2.25% to 1.75%, it's likely that we're going to see an increase in loan applications. And in order to keep our standards around loan to close time and prevent any further loan abandonment, we may need to hire on more mortgage closers, processors, underwriters, and even mortgage recruiters in order to obtain and keep the business of any of our prospective clients. With a quick view into our variable hiring needs, as well as our non-variable staff, we're able to keep a close eye on our salary expense as well as any other headcount related expenses. So within a matter of minutes, I'm able to view and maintain multiple views of our balance sheet, make changes to our single family residential fixed loan sell versus retain percentages, shift our credit card expected losses on a branch by branch basis, as well as change the expected increase in new business customers, assess and maintain our securities and deposits information, as well as instill an organized wide change to our service fees associated with money orders, and finally become a more forward-looking organization towards the federal interest rate and how its fluctuations determine our variable staffing needs, so that we get out in front of any potential hiring needs in order to maintain our industry-leading customer satisfaction and loan closure standards. For a more personalized demonstration on how Active Cyber is able to customize this solution to meet your specific needs, please reach out to sales@activecyber.com. Thank you so much.